So the first question is, each share of non-participating 8% cumulative preferred stock. That means there are participating, non-participating preference shares. Participating preference shares, I think they can share profits, or they may have some voting rights. I'll just give you the like clear this thing about participating preference shares. Just a second. Participating preference shares are type of preference or preferred shares with special rights to participate in profits, as I said right now. So non-participating preference shares, they have no rights to participate in surplus profits. Participating have, but non-participating will not have surplus profits in event of liquidation. Right? Next. So each share of non-participating 8% cumulative preferred stock in a company that meets its dividend obligations has all of the following characteristics, except dividend payments that are not tax deductible by the company. They said like each share of this category in company that meets its dividend obligation has all of the following, except what? Actually, the preference shareholders do not have any voting rights. Okay, they do not have voting rights. Dividend payments that are not tax deductible. It is very clear cut fact that dividends are never tax deductible. Am I right?
Yes, sir.
Interest payments are tax deductible. But dividends are never tax deductible. Okay. Superior claim to common stock. Of course, preference shareholders will get the claim before the common stockholders, and it's non-participating. Whatever, they will be the one who have to be given the priority, right? No principal repayments. Preferred stock normally need not be redeemed as long as the corporation remains in the business, right? Now, second, preferred stock may be retired through the use of any one of the following except a. See, call provision. Of course, preferred stock can be issued with call provisions. That means company can buy back. Sinking fund, they can accumulate money for making the payments, right? Hello.
Yes, sir. Hello.
But I don't think how sinking fund they are giving in case of this. Conversion, preferred stock or even convertible. They can be convertible into preferred stock. They have conversion feature. But refund is not done in case of preferred stock. It's done in case of debt finance. Okay.
No.
Generally, what I think is preferred stock is equity actually. So there are some redeemable preference shares whose money has to be paid back. I don't know. They did not say anything about it. Retired in the sense except a refunding. Yeah, like preferred stockholders. A refund, that means the money has to be given back only. That's the actual feature for debt finance, not for the preferred stock. Exception is in some of the cases. Are you understanding?
Yes, sir.
The redeemable preference shares have to be paid back. I don't know why, but debt finance you have to pay back. That's the case. All of the following are characteristics of preferred stock except. Can you just answer this? Can I say this?
So,
Because dividends are not tax deductible, right?
and C, option C.
They don't have voting rights, of course. Equity holders have voting rights.
Yes. Except.
Equity holders are the actual owners. They have the voting rights. Participating, non-participating, I already explained you. Participating
Yeah.
is they get the surplus share of surplus profits. This can be issued with call provision. They can be converted into preferred stock. We have convertible
Right.
preferred stock, right? Only
Yes.
this is the option.
Yeah. Okay.
Next question. Which one of the following rights is ordinarily sacrificed by the holders of preferred stock in exchange for other preferences received over common shareholders? The right to share it in residual assets of the company upon liquidation. The right to share in periodic earnings of company through the receipt of dividends. Right to vote for members of board of directors and in other matters requiring a vote. Right to accrue dividend payments in arrears when payments are made for a period of time. Can you just answer this?
Right to vote.
Yeah, see which one of the following rights is ordinarily sacrificed by holders of preferred stock in exchange for other preferences received over common stock. See, preference shareholders are getting the preference over common stockholders. That's a known and understood fact. Right to share in residual assets of the company upon liquidation. See, they will be getting priority. Preferred stockholders have priority in assets and earnings. If the firm goes bankrupt, the preferred shareholders have priority over common shareholders. So here
Yes.
they will get before the common shareholders only, right?
Yeah. Right.
See, preferred stockholder received their dividends before common stockholder received. So right to share periodic earnings of company through receipt of dividends. I don't think they are going to do this. Right to share of periodic earnings of company through receipt of dividends. So which one of the following rights is ordinarily sacrificed by holders of preferred stock in exchange for preferences received over common shareholders? This is a by default feature, right? Preference shareholders always receive their money before the equity shareholders.
Right. Yes, sir.
Right to vote, I don't think they have right to vote. This is a wrong statement. Okay, and they can get dividends in the next coming year also. That is a special feature of cumulative preferred dividends. Did you understand?
Hmm.
Cumulative, there is one share called cumulative preference share and non-cumulative preference share.
Non-cumulative.
So for cumulative, they get dividends in arrears also next year. Understood?
Yes, sir. Okay.
Voting rights they never have. Next one.
Convertible preferred
See,
stock.
yeah, convertible preferred stock. Actually, the following except was taken from the company financial 10% convertible participating. Participating preference shares are preference shares. Convertible bonds are also there, but convertible participating bonds nowhere, right? So preferred stock. Next question. The equity section of statement of financial position is presented below. Equity section has all the equity, right? Preferred stock, common stock, paid up capital, retained earnings. So the common shareholders have preemptive rights. What do you mean by preemptive rights? They have the rights to buy the stock of the company, which is issued. See, whenever a new issue would be done in the future by the company, the
Yeah.
first right is with the existing common shareholders of the company. They have the rights. Rights
To
issue is
buy.
done, right? Rights issue. Yeah.
Okay.
So they have the rights to buy the stock of the company. Okay, because they have the owner. They are the existing owners.
Okay.
Okay. They can maintain their current percentage of ownership. So if an additional 400,000 shares uh, of common stock are issued at this, the current holder of 20,000 shares of common stock must be given option to buy how many shares? First of all, we will see how many shares are there, right? So How many shares? I think 20 20 lakhs, I think. Yeah, 20 lakh shares are there, correct?
Yes, sir. 2 million.
Yeah, and 20,000 shares, see, of an additional this much common stock are issued at the current holder of 20,000 shares of common stock must be given the option. If I see uh, the common shareholders have preemptive rights. If an additional 4 lakh shares of common stock are issued at this price, the current holder of 20,000. So someone is holding 20,000 shares. So what did I say? Common shareholders have the preemptive rights, correct? Which means they have first right to purchase any new issues of common stock in proportion to their current ownership percentages. What is the proportion of this shareholder in the current like outstanding shares? 20,000 is like divided by 20 lakhs, right? Into 100. 1%. So a person has 1% in this, correct? Hello.
Yes, sir. Hello.
This current shareholder, how much holding, how much proportion of the total shares he holds? Just
1%.
1%. So he is entitled to get 1% of this additional shares. So 4,000 shares. Are you understanding?
Yes,
So whatever the proportion he has, that much only he should be getting the like he has the preemptive rights. The proportion of shares what the shareholders have in the company, the additional shares what are issued out of that, that much proportion of shares they are entitled to get. So we already calculated the proportion of the current shareholder in the total shares in the company, in the total holding in the company. We found that it is 1%. So definitely, like in this additional shares also, he will be getting 1%. That is 4,000, right? Shall we move forward? Shall we move forward? Hello.
yes, yes, sir. Yes.
Yeah. Next question. The par value of a common stock represents what? The theoretical value of $100 per share of stock with any differences entered in the issuing corporation records as discount or premium on stock. See, par value can be any amount more or less than 100. It's not necessary that it is $100 only. In case of bonds, you see denomination of 1,000 or $100. Understood? Par value can be $1 also. Is it right?
Yes, sir.
Am I right or wrong?
Yes, sir. Yes.
Total value of the stock that must be entered in the issuer. So 100, you should not keep 100 as standard. So this option is not going well. The total value of stock that must be entered in issuing corporation's records. So total value, all assets received for stock must be entered in the corporation records. The amount received is very rarely the par value. See, the total value of stock that must be entered in the, just a second. The total value of stock that must be entered in the issuing company corporation's records. See, all the the company has issued the stock, right?
Yes.
So whatever the money has been received for the stock should be recorded in the books.
Mm.
But do you think always whatever the money the company receives for the stock is always equal to par value?
No.
No, whatever you, always the total value of the stock you're getting is not always equal to the par value. It's understood fact. Because sometimes you may get less, sometimes you may get more.
Yeah.
Estimated market value of the stock when it is raised. No. Par value is rarely same as the market value. So no. Liability ceiling of shareholder when a company undergoes bankruptcy proceedings. See, par value represents the stock's legal capital. So par value or face value is the legal capital. Legally what you are showing in the books, right? It
Yes.
is a very arbitrary value assigned to stock before it is issued. Par value represents shareholders' liability ceiling because as long as the par value has been paid in the corporation, the shareholders obtain the benefits of limited liability. That means the shareholders have the liability which is limited to the extent of holdings what they have, and that is the fixed that is fixed to the par value of the company only. That is fixed to what?
Par value
So
of
that the liability of the shareholders is what towards the company, the how much the shares they hold, and that shares multiplied with what? Par value. Correct.
yes,
That is the agreed value what they have at which they have bought the stocks. Correct. Hello.
yes, yes, sir.
So the
Yes,
liability ceiling of a shareholder when company undergoes bankruptcy proceedings. So their liability is restricted to only the par value. Okay. Next. Eighth question. This can be the last one because next you have to do. Which one of the following statements is correct regarding the effect preferred stock has on company? I think preference shareholders claims their precedence over the claims of common shareholders in event of liquidation. Can I say this? Hello?
hello.
Yeah. Preferred shareholders claims their precedence over claims of common shareholders in event of liquidation. First, they should be given, right?
Yeah, yes, sir. Hello.
Yeah, yeah. Now, a control of the firm is now shared by common and preferred shareholders with preferred shareholders having greater control. No. See, the common shareholders have the greater control, right? They have the voting rights, not the preferred shareholders. Am I right?
You're right.
This is a wrong statement. Firms after tax profits are shared equally by common and preferred shareholders. Never. Non-payment of preferred dividends places the firm in default, as does non-payment of interest on debt. See, non-payment of interest on debt places them in default, but non-payment of preferred dividends can only happen in case of losses. Why in the case of losses company will pay preferred dividends? Again, wrong statement. You can't compare the preferred dividends with the interest on debt, right?
Mm.
Interest on debt not paid is a default, but preferred dividends not paid can be a feature when there is no profits, when the company is in losses. The dividends are only paid when the company is in profits. Am I right?
Yes, sir.
So this section is done. Rest of the questions you have to do something. All are theory questions. Shall we move to the next one?
Okay, sir. Yes.
We are moving to the dividends now. First question. Please read this. Corporation has 6,000 shares of 5% cumulative $100 par value preferred stock. Read this, please. Corporation has 6,000 shares of 5% cumulative $100 par value preferred stock outstanding. So corporation has 6,000 shares and that is paying 5% dividends, and that is cumulative shares. Cumulative what? Preferred stock has a par value of $100. Okay. So preferred stock of $100 par value with 6,000 shares and 2 lakh shares of, so common stock they have 2 lakh. Corporation's board of directors last declared dividends for the year ended May 31st, year 1, and there were no dividends in arrears. So they have declared, it seems, in the month of May.
Mm.
In the first year, in the month of May, the dividends were declared, and there were no dividends in arrears. That means have been paid, it seems.
Okay.
Yeah, for the year ended May 31st, year 3. So third year. We're speaking about the third year. The corporation had net income of 1750. The board net income. Board of directors is declaring a dividend for common shareholders equivalent to 20% of net income, right?
Okay.
The total amount of dividends to be paid at 31st May year 3 is what? So can you tell me? See, very simply, the net income is 1750, right?
Yes, sir.
On this, the 20% is given as the common shareholders will be given as dividends of 20%.
20%.
So
3 lakh
of yeah, so how much? 3 lakh
50,000.
50,000. And this is what? On preference share also they will be giving dividends, right?
Yes. 5%.
How much? That is for how many years they will be giving?
Third year.
Yeah, for no more 2 years they'll be giving these dividends, right? Because dividend is given fixed on preference shares.
Yes.
Did you understand? Hello.
Two.
For 2 years they'll be giving fixed dividends, right?
Okay. Okay.
Yeah. So 30,000 for a year, then 60,000 for 2 years.
60,000.
So it comes to 4,10,000.
Yes.
Make a note of this. And one more thing I will tell. This is cumulative preferred stock, first of all. What kind of preferred stock it is?
Cumulative preferred stock.
So whatever dividends are to be paid in the first year. So if a company has cumulative preferred stock, all preferred dividends for current and any unpaid prior years must be paid before any dividends can be paid on common stock. Did you understand?
Okay, sir.
So
Yes.
the previous year and the current year, every year's dividends have to be paid because it's a cumulative preferred stock. After finishing this, please tell me.
Yes.
Since it's a cumulative preferred stock, 2 years dividends are given here.
Oh, done,
Let's go for this question.
sir. Company.
Company has 1,000 shares of $10 par value common stock and $5,000 of retained earnings. They have 1,000 shares at the rate of $10. So that is $10,000, right? And the retained earnings is $5,000. Two proposals are under consideration. The first is a stock split giving each shareholder 2 shares for each share formerly held. So for every 1 share, they are giving 2 shares, right?
Two. Yeah.
The second is to declare and distribute 50% split up affected in form of dividend. That means they want to split if 10 stocks are there, they want to split into 20. 50% split they want to do.
Hmm.
So, what are they asking now? Under list A, the par value outstanding and share the par value per outstanding share will, and list B, they're asking list A, the par value will be what, and also under list B, it will be what? So split up affected in form of dividend. Actually, par value per share does not change following a split up affected in the form of dividend.
Okay.
Split up effect in form of a dividend. Par value of share does not change following a split up effect in the form of dividend. That is also not possible. See, you have to split the stock, not the dividends, right?
Yes, sir.
Split up stock split decrease, stock split increase. A stock split results in lower par value per share because the total, see, why are they doing the splitting? First of all, the splitting is done because the shares are not marketable now. They are very costly. So to make them cheaper, suppose there is a stock, one stock is of $100. I want to split this into 10 stocks. So this will not change my capital value, but number of shares will decrease, right? How? I will split this $100 stock into 10 stocks of $10 each. Can I do this? So this is
Yes.
decreasing my value or not?
Decreasing.
So a stock split results in lower par value per share. So here the par value has decreased, right? Because the total number of shares increases, but the total par value of outstanding stock does not change. The number of shares have increased, I know, 10 stocks, but the par value, the total par value is still 100, right? Why $100? 10 stocks into $10. So this is the answer. Stock split, do you think it increases? No, it decreases. Wrong. Shall we move forward?
Yes. Here the stock increases, but the par value will remain same.
Number of stocks increases, but the par value will decrease, right?
Oh,
Yeah, it will decrease. That's what. Next question. Same question they have. Same question. Yeah, when determining the amounts of dividends to be declared, the most important factor to consider is, see, how much amount you have to declare for dividends. What will you consider?
earning.
Future planned uses of cash. See, you should be seeing whether you have enough cash or not. How much amount you want to declare as dividend. The most important factor what you'll be considering only is the cash. If you should have enough money in the future to make these payments, right?
Yes.
And otherwise, you should also think that instead of giving that money as dividends, why can't you invest that in some other investment option whereby you can get some higher returns? Isn't it so?
Yeah.
So only this factor is the most crucial and important factor. What about other factors? Impact of inflation of on replacement cost does not affect a decision concerning the amount of dividends to be declared. See, inflation, of course, you want to replace some asset with some another asset, and for that you are thinking the asset with which you want to replace the old asset,
Mm.
like the asset which you want to replace the old asset with, that asset may have higher value in the future due to inflation. So this is not the point to be considered with dividend declaration,
Different.
right?
Right.
Expectation of shareholders. Shareholder expectations would not affect a decision concerning the amount of dividends to be declared. Alternatively, investors may select investments that have traditionally matched their expectations, but this is not a decision facing corporate directors. See, expectation of shareholders means what? When determining the amount of dividends to be declared, the most important factor to consider is expectation of shareholders. Do you think they are not concerned with the amount of dividends that directors will decide? They are only concerned with the dividends, right?
Okay.
They don't see how will they decide what is the amount of dividend they're going to get. It's
Yes.
very tough, right? It
Yeah.
depends upon the profit and the directors will decide.
Mm. Yes, sir.
Future planned uses of retained earnings. See, retained earnings is, it's a book figure actually, not physical cash, right? So only cash is what should be considered in this case. Next question.
Stock dividend.
I think in stock split, a large number of new shares replaces the outstanding shares because $100 one share has become now 10 shares, right?
10. Yes.
So first of all, one more thing I would like to tell you. Stock split, there is no accounting entry you will pass for this.
Okay.
Instead, a larger number of new shares are issued to replace and retire all outstanding shares. What about this? Stock splits are paid in additional shares of common stock? No, stock splits are not. Stock dividends are paid as additional shares. Bonus shares.
Hmm.
Already existing shares, whatever you have, to that you will be giving more number of shares. Why? Because you don't want to give cash dividends. Are you understanding?
Yes. Yes.
So stock splits are paid in additional shares of common stock is wrong. Stock dividends are paid in additional shares of common stock. Whereas stock dividend results in replacement of, no, this is wrong. This is for stock split.
Okay.
Stock split results in replacement of all outstanding shares with new issue of shares.
Hmm.
Stock dividend results in decline in par value per share. How?
The stock split.
Very good. So stock dividend is not stock split. That will reduce the par value. So stock split is the one which is going to do. Stock dividend is not going to affect the par value of stock, because apart from the stocks, these are the additional shares which are given. That can dilute the earnings per share. That I can accept because number of shares are increasing. Actually, I don't think there's any accounting entry which is required, right?
Okay. No
Because
accounting.
it is not changing the capital accounts at all. The capital is still the same.
Same.
Number of shares have increased. That's it. I told now one share of
Yes.
$100,
Yes. Yes.
10
10.
shares of $100 of $10. Same.
$10. Right.
Last question. We will do this last question. Next one. Firm has 1,000 shares outstanding and retained earnings of $25,000. Theoretically, what would you expect to happen to price of firm stock currently selling for $50 per share if 20% stock dividend is declared? First of all, what is the total market capitalization? 1,000 shares into 50. How much?
50,000.
$50,000, right?
Yes.
And retained earnings is 25,000,
25.
right?
25,000.
What is the 20 if a 20% stock dividend is declared? What will be the 20% stock dividends of 1,000 shares? 200, right?
Yes.
Stock dividend. Correct?
Yes.
So now 50,000, they are saying that a firm has 1,000 shares outstanding and retained earnings of 25,000. Theoretically, what would you expect to happen to the price of the firm stock currently selling for $50 per share? If you declare 20% stock dividend, with 20% stock dividend, number of shares are how much now? Now, how much number of shares are how much?
1,200.
1,000 old shares, 1,000 and 200 shares new, right?
200 new. Yes. 1,200.
And the total valuation is this much, total capital. We'll divide with 200 shares. So $50 was the par value. Now how much is the value?
44.
41.67. It should decrease, right?
Yeah, okay.
So we will continue with the sixth question tomorrow, Samrin. Sixth, how many questions we need to do in this? Dividends have 36 questions.
36 questions. Yeah.
So 36, we have done 5. So we need to do 18, right? So 13 questions more we will do tomorrow. Okay. And we will immediately move to the next chapter. The next chapter is financial markets and financing. Okay.
Okay.
Okay. Okay, Samir. Thank you.
Thank you.
Thank you.